UK inflation was supposed to jump this month. Petrol at a 3-year high, a war pushing up oil. Every forecast said the number would climb, but it didn't. It just sat there literally, completely flat. 2.8%, exactly the same as last month. And that's actually stranger than the jump would have been. The headline saying nothing changed is hiding two huge things changing in the background. One of them is quietly aimed at your job, which in turn will hit your wallet. You'll see the 2.8% headline everywhere for this month. What you won't get is the detail of what's underneath it. A fight between your petrol tank and your weekly shop. What the bank just decided to do about it, and the one number that decides whether they hold or hike next. 3 things: why the flat number is a lie of omission, who's actually getting squeezed, and what to do about it. So, why didn't it move? 2 big forces cancelled out. On one side, fuel went up very hard. Petrol hit 157 pence a litre, the highest since 2022. Filling the car is up about a quarter on a year ago. On the other side, 2 things fell. Your gas and electricity are actually cheaper than last year, roughly 6 to 13% lower because the price cap dropped. And food inflation fell to its lowest since 2024. Add a big up to a big down, and you get a flat 2.8%. So inflation unchanged isn't calm. It's just a fuel shock and a food drop cancelling out to a draw. And notice the trick in the word energy. The bill on your doormat got cheaper. The fuel in your tank got more expensive. But headlines usually crush those numbers together and call it energy, but they're actually moving in opposite directions. One more thing the number hides. This is May. May was peak fuel. Since then, oil has been falling, and oil alone dropped nearly 20% in a month as the war panic faded, and that's for heating oil. So, fuel at a 3-year high is probably the top of the hill now, not the bottom. Unless, of course, the whole war situation implodes on itself, which it could very much do. But the headlines are looking backwards at the worst of it. Quick one, because someone's thinking, I don't even drive. Fuel isn't just your tank. It's the lorry bringing food to the shop, the heating where you work, the van delivering your order. When fuel's high, those costs ripple into everything very slowly. That's why 1 month of petrol doesn't blow up the whole shop at once. Businesses absorb some and pass the rest through over months. It's a slow leak and not a flood, which is exactly why this month got outweighed by cheaper energy and cheaper food. The inflationary pressures are going to be slowly leaking in over time. Now the part I really want you to hear, because it's where this hits home. Everyone frames inflation as your shopping costs more, but your employer is squeezed by the same costs: fuel, energy, materials, and they often can't just raise prices to cover it because we're all broke and we're just going to stop buying. So what gives? Their margin. It gets thinner, and when margins get thin in this order, pay rises shrink, hiring will slow, and if it gets really bad, jobs will get cut. So the same shock that's in your shopping is quietly in your payslip too. It's going to hit you twice. And it's not even. If you work somewhere with thin margins already, like retail, hospitality, a lot of small businesses, there's less cushion before it reaches your job. That's worth being honest with yourself about, because where you sit will matter. The real takeaway is a shock like this doesn't just move money around. It's going to make everyone a bit poorer at once, you and the business you work for. Here's the bit that genuinely matters, which most people don't talk about. Strip out the volatile stuff. You get rid of the fuel and food. Just look at services for now. So things like haircuts, restaurants, rent, insurance. That number jumped to 3.7%. Now, why is that important? Because services inflation is the homegrown kind. It's driven by wages and domestic costs, not usually a result of external factors like the war on the other side of the world. It's the bit the bank watches a bit more closely because it can influence that more strongly with domestic monetary policy. Honest caveat though, and you won't hear this either way on the news, a chunk of that jump is an accident of the calendar. Easter fell early this year, which made airfare spike in May, so services at 3.7% is part real and part timing. But don't let anyone scare you with it, and don't let anyone wave it away. It's going to be somewhere in between. Just remember this number, it will come back at the end. So, the Bank of England made its call this week. It held. Rates stay at 3.75%, the lowest since early 2023. And here's a satisfying part. The reasoning is basically the argument we just made. The bank said, in its own words, that it can't do anything about global energy prices. So when a shock comes from outside, the right move is to look through it and wait, not to start hiking. The governor went further. He pointed out this isn't a repeat of 2022. The energy jump is smaller this time. Rates were already high going in, and the key one, the jobs market is weaker now. So slamming rates up just kick an economy that's already wobbling. You can't fix a war with interest rates. But here's the bit to actually remember. The hold is on the leash. The governor's basically said he'll let inflation run a little hot for now to protect the economy. And the one thing that ends that patience is wages starting to chase prices. And how do you spot that coming? The services number from earlier. If services keep climbing, this calm little hold quietly flips into a hike. That's the tripwire. And it wasn't a clean sweep. The vote was 7-2. 7 backing the hold, 2 who wanted to raise straight away. So this is a finely balanced call, not a slam dunk. And those 2 weren't actually being silly. Even while holding, the governor himself warned there are, in his words, inflationary pressures in the pipeline. That services number and the oil still slowly working its way through. But the 7 who held were weighing the other side of the scale. The economy is already weak, and with the outlook of the war now looking a little bit better, that oil spike is more likely to fade than feed. And that's a whole balancing act. Hike rates into an economy that's already wobbling, and you don't tame inflation. You just spiral it into a worse position. Raising right now simply wouldn't make sense. So the majority decided the bigger danger is the downturn, not the pipeline. And that's why the favoured move, the hold, won at 7-2. One detail nobody's putting aside, the same war, but a week earlier, the European Central Bank actually raised rates. We held, they hiked. Not a contradiction, it's just different starting points. There's no single right move here, it's all trade-offs. So, what do you do? Just so it's said, this isn't financial advice. It's strong opinion with the context most people skip. You make your own call. Number 1, don't make a panic money move off of a number that's already turning around slowly. Constant observation is good now because stability is being forecasted for the future. Fuel's falling, the bank held, and mortgage rates have slowly drifted down a tiny bit. Several big lenders trimmed fixed deals this month just because the market's changed to perceiving stability now, not the hikes that we thought. There's a potential risk in locking into something more expensive now than that of a few months later. Borrowing costs are still high and it won't go dramatically down even if the war is fully over. It's going to edge slowly downwards. 2. Make this a build a buffer year, not a big bet year. If margins tighten, the most valuable thing you own isn't a clever investment. It's a few months of breathing room and not being the easiest person to cut. 3. The career one. If money's tight where you work, be the person tied to bringing value to the company, not the one who looks like a cost. The roles with no value tend to go first. I'm not trying to be cynical, but it's just how business finance usually works under pressure. 4. Watch fuel and that services number, not the headline. The 2.8% is a rear view mirror. Current news is all about oil, and oil right now tells you where the next few months can go. Services usually tell you whether the bank's hand gets forced. This is why some voted in favour of a rate rise. Because of the services inflation number and oil inflationary pressures still left in the pipeline. If oil continues to stay down and wages stay calm, this should hopefully ease by autumn. If either breaks the wrong way, we go again. So, the number didn't move, and that could be said to be the suspicious part. A fuel shock and a food drop cancelled out. The homegrown number quietly elevated, and the bank held. But only as long as wages behave, oil pipeline inflation isn't as detrimental as thought, and economic growth remains somewhat functional. Right now, it's all about patience and a buffer, not panic. If those things I spoke about go wrong, and it very well might, we'll talk about it again.